Private markets have been in the news recently, investors considering the risks in private credit funds. But our guest today says the problems in credit shouldn't give the entire asset class a bad rap. Joining us now to discuss is Colin Lynch, head of private markets with TD Asset Management. Colin, great to have you back on the program.
Greg, thank you for having me. It's great to be here.
Yeah, this is an interesting topic because, of course, people see the headlines to go away, then they resurface again. They're hearing private markets, they're hearing private credit, they're getting some bad news wrapped around that. What's actually happening here? What's beneath the surface?
Well, it's a great question. There's been a lot of headlines, as you mentioned, and we've seen this in other spaces, whether the real estate space in various ways, and even in the infrastructure space as it relates to energy. The headlines have been around private credit. It's important to step back a bit and just look at the market at large. So the headlines have been very focused on an aspect of private credit related to software. And in particular, it's the loans made by private credit entities and some concern around whether it's defaults or what we call shadow defaults, meaning whether it's a restructuring on the loan provisions, whether it's delay in payment of interest, et cetera. And concerns not just about the quantum, meaning the volume of defaults happening or shadow defaults happening, but as well concern around transparency, right? And so that's really the headlines. And if you step back to look at the market at large, private credit does not just exist to lend to software companies. It exists to lend to a variety of different firms, variety of different industries, variety of different types of borrowers. So not just companies, but also in the infrastructure space, in the energy space, even PPP partnerships, public-private partnerships. It's a broad space. Second is there are multiple types of investors in that space. And so where we see a lot of headlines is really around what we call retail, but you can also say high net worth, concern from those investors on some of the underwriting and transparency on the private credit space. And that concern has resulted in redemption requests. And those redemption requests come through in particular vehicles, one of which are called the BDCs. And every time those BDCs are unable to satisfy all the redemptions, they implement what they were designed to do, which is a gate, and say we cannot pay beyond X% of the value of the fund. And when that happens, there's a headline. And the headline then sparks more interest and perhaps more redemptions. But effectively, the BDCs are doing as they were designed to do from a structure perspective, meaning when there's elevated redemptions, they implement a gate. Why? At the end of the day, it's private credit. It is, by definition, less liquid. And so that's key. Last thing I'll say, retail investors are a minority of the investors in private credit. The majority, vast majority, are institutional investors. And in the same quarter that retail investors withdrew about $25 billion across the world in terms of private credit, institutional investors put $100 billion into private credit. And so there's a distinction and a difference, I would say, in the level of confidence between the two types of investors. And if you step back and look at the private credit world writ large, it's generally quite healthy, though the headlines would not yield the same conclusion.
That makes me think in terms of this tension we're having here between a retail investor and how they're seeing, private credit, private markets, and institutions who have a much longer timeline. Is this really a great area for the retail investor to be in? It seems very much geared towards institutions who have very long timelines. We'll just hand off a portfolio to the next generation and say, this asset's working for us.
Look, it's a brilliant question. My short answer is yes, with the caveat, it depends. So let's start with the caveats, and then I'll get to the yes. The caveats are, to your point, your requirement for capital. If your requirement for capital is tomorrow, it's not a good place to invest. If your requirement for capital is a year from now, it's also not a good place to invest. One has to, when investing in private asset classes, doesn't matter what type, you have to have a long-term view. So that's the first point. Second point is, clearly when you look at your whole portfolio, some of that portfolio you'll probably need access to sooner than other parts of that portfolio. And that is one of the considerations one should have when one decides how much illiquidity can you afford in your portfolio. The biggest investors in the world have up to 50%, some even more, of their portfolios in illiquid assets in the private markets. But for most individuals, that answer is nowhere close to 50%. It might be 10%, might be 20%, might be 0, might be 30%, but it really depends on your individual needs. Now, so that's the caveats. Let me get to the yes. The yes meaning are these asset classes, not just private credit, worth investing in? The solid answer is yes. Why? Because academic research shows you receive a premium for investing in the private markets. There's a bunch of reasons why, but one of those reasons are higher quality assets tend to be privately held. You do receive a premium, but also you're able to reduce what we call the standard deviation of your portfolio. So you can do both, increase returns and reduce risk. Part of that is the nature of the assets. Part of that is how they interact with the rest of your portfolio. And so if you can have the appropriate liquidity horizon, it is worthwhile. But that liquidity point is super important. And I would say in the market writ large, that point historically has been underemphasized when that point really should be emphasized.
Now, you talked about the fact that, we're talking about subsets of the market. We're talking about private markets, now we're into private equity. We're talking about software loans that were made. How are the concerns about that playing out across the private equity space?
Yeah, it's fascinating because if you just think about it, private credit is debt, right? And your first position, you might be subordinate debt, so maybe second position. But the point is, to get your money back, you're ahead of the equity holders. But the headlines have principally been about debt and really haven't talked about the equity side. Why is that? Part of the reason is, on the private equity side, you have different structures, different vehicles. Most of those vehicles are closed-ended. What that means is when you commit to that vehicle, you know right from the get-go, you're not getting your capital back until that vehicle's invested, they've done the work with that investment, and they've sold. And they might have the right, legal right, to extend that vehicle a couple of times. So what does that mean? 10 years, 11 years, 12 years, maybe 15. And so therefore, your money's locked in. So even though you might have greater exposure or risk profile as it relates to private equity, investing in some of those same software companies that private credit firms have lent to, you see more headlines on the private credit side because folks are rushing to get money out of different types of structures that provide, whether it's quarterly liquidity or annual liquidity, whereas many of the private equity structures do not provide that liquidity. So therefore, hard to put in a request for that liquidity because you know it's not happening, and therefore you don't see as many headlines. One caveat, there are a few private equity funds that are what we call evergreens, so perpetual, that do provide liquidity on a quarterly or annual basis. And for some of them, we are beginning to see redemption requests related to the software issue. So it's not completely all the way over here on private credit with the headlines and none here on private equity, but the vast, vast majority of the headlines on private credit, and that's really because of the different structures between private credit and private equity.
So if someone comes up to you and says, Colin, what's the big takeaway on private markets right now, given everything that's happening? What would the takeaway be?
I would say this. We have had so many headlines across the spaces, whether it's in the real estate space or in the infrastructure space. We've had a lot of volatility. We've had a lot of concern. And yet, the private markets have done exactly what they are supposed to do. They deliver value-add performance, and they help reduce portfolio risk.